Welcome, welcome everyone to the call. Excited to have you all on this evening. So I know it's a little late there on the East Coast, so it's probably what about 7 p.m. Yeah. So this will
Yes.
be it'll be good. Oh yeah, Ben, you got the late time. All of us West Coast people are still working really hard. So
You think work stops at 7 p.m. over here?
yeah. No, the work never stops. Y'all just get an earlier day while we're still catching a bunch of Z's over here. So I swear things don't, I grew up in Texas originally. And when I moved to Arizona and then California, I swear people don't like start their work days till like 9 or 10. I was like, geez, do y'all work around here? And then they like work throughout the night. So anyways, pretty funny. All right, so I'll go ahead and kick things off. So welcome everyone to today's webinar. I'm excited for those of you that have chimed in this evening. We will be recording this. We will be monitoring the chat line, and we'll put out a recording after this. So for those of you that don't already know who I am, I'll do a brief intro of myself, and I'm assuming you got the email that I sent out this morning. So my name's Aaron Halderman. I split my time between Phoenix, Arizona and Southern California. I'm the host of the NoteWorthy Summit. I've been running Note Tools for a number of years. I also work with directedira.com, which is a self-directed IRA custodian based in Phoenix, Arizona. I got into the note industry, about 10 years ago. And our special guest this evening, Kevin Shortell, I went to probably, I don't know, at least a dozen or so of his 2 to 3 day workshops that he was doing. I'm a big believer in continuing education and making investment in yourself. And so I always did that. I was at an annual conference with a trust company years ago, and they had a bonus pre-day that was going over notes. There were several speakers on that. I bought every single course that was offered, every single workshop that was offered, and that's actually how I met Kevin. So there's a lot of power in going and attending live events and attending webinars like this and showing up to actual live events as well. I got started purchasing first liens, then I started purchasing junior liens. Prior to that, we did some rentals and some fix and flip properties, but I more or less cut my teeth in paper, for lack of a better word, going all in, which I've diversified since then. But we had a full-time asset management shop running that, and we're a decent bulk buyer of assets and working those out. And then we started a buying group and allowing others to participate in some of our trades and teaching some of the things that we were doing for workout strategies. But I credit a lot of what I learned in the business to going to live events, live workshops, and working with Kevin and all of his years of experience. So about a week ago, I was doing we have a twice a week, we have a conference call to discuss company matters. And we're like, we should really do a webinar and discuss kind of what's going on in the space, what to look forward to this year, what's on the horizon. And Kevin said, well, let's call it the third wave, and I'll let him explain why he's doing that. But Kevin runs the Kevin Shortell podcast. He also has his domain up there, kevinshortell.com. He has some private courses and training that he offers, and great value add. Highly recommend all that. I'm just a great teacher and educator, and has been in the space for over 20 years, and was recognized as Note Investor Trainer of the Year last year, and so that's pretty cool. Also want to introduce Ben Fredericks. He'll be our co-host at NoteWorthy Summit, and he also is now a partner at NoteWorthy, so we're excited for that and his experience. Ben comes from the insurance, financial services, and mortgage underwriting space, and he and his investment partner will share their story at the summit end of February, the February 27th through the 29th in Anaheim. But they purchased, just over 200 notes in less than 24 months and have kept them in-house, worked them with their capital and some private investor capital. And so they've accomplished a bunch of great things too. Ben's a great implementer, great at marketing. And so we're excited for what he brings to the space and his knowledge and notes and real estate. So that's what we have going on today. I'm going to turn the time over to Kevin. He's prepared some slides for us to review. We're going to try and keep this, a good 15, 20 minutes. So we'll be respectful of your time and excited to share with you what's coming up. And then we'd love to have you out at the summit. So we'll, again, February 27th through the 29th, NoteWorthySummit.com. We'll have a special pricing offer that we'll put on there for those of you that stick with us. Again, it will be recorded. We'll be taking a look at the chat, and we'll be ready to rock and roll. So, Kevin, welcome. Ben, welcome. Thanks for being on.
Absolutely. Looking forward to this, looking forward to the summit coming up. And I appreciate the introduction. I've had the good privilege, everybody, to do state of the industry addresses really for the last 9 or 10 years within the industry. So it is something that I concentrate and look at on a daily basis, something that many investors simply cannot do. But it's a part of what I do as an educator. It's a part of understanding the business and what can likely happen in the future. And if you've been invested in real estate as long as the panel here in regular, more traditional real estate and the note business, there's fluctuations in the marketplace. And I don't know of a single person who is actively involved in real estate that didn't get hurt on the last big down crash. It happened very, very quickly. There were signs that it was happening, but it just happened very, very quick. And after I went through that, I said, you know what, never again. I'm going to become a student to the marketplace. So I've been studying the market ever since then. And it's been amazing to see within the note industry, all the different changes that has happened. The opportunities have grown. They shrunk a little bit. They're growing back. They're moving in different directions. And if you are educated to the point and keep up with the marketplace, you'll know where to direct whatever techniques that it is that you need to utilize to maximize your profits and minimize your risk. And I think that's really the name of the game. And I know Aaron does that. I know Ben does that in his business. So I'm going to go through this a little bit quickly to give you some direction. Ben's going to contribute some things as we progress towards the end as well. To show you where the opportunity is. So this is a snapshot of the sort of thing that really you can only learn by being involved, as Aaron was saying, getting involved and learning the language of the business and the pace of the business here. So let me go ahead and just jump right in. First of all, I do a lot of research, and many of you, if you are in the note business, you probably are familiar with DS News, but everything I do, I like to source. I like to show people I've done my homework, and I look at about 20 different sources on a regular basis. And all of a sudden my slides are going automatically there. Hang on a second. Let me go back to that. I think I clicked the wrong button there. Okay, we're back to this one. There we go. So I do thoroughly research everything and document everything, but as these two gentlemen can tell you, I've been talking about this next wave of real opportunities for quite some time here. And I don't know why my slides are going a little nuts here. So I'm going to just go on the fly here and do this a little bit differently. Not sure how that automation got in there, but I trust that you all can see that. Okay. So I'll just work it this way. Sorry about that. Not sure what that issue was.
Looks fine. Yeah, it looks fine. Yeah,
okay.
Good.
So I've combined this with several other sources that I look at, but as I was saying, these gentlemen can tell you that over the years, especially last year, I started talking about this. There was some concern last year that the note inventory was going away. And that really wasn't the case. It's going to go through some cycles, some changes, because we do as investors affect the overall market as well. So the first wave, which most of you are very familiar with one way or another, were the loans that were originated in 2004 through 2008. And we had some risky loans, right? These were the no-doc loans, the pick-a-pay payment loans, the interest only, 110% loans. I mean, it was everybody on this webinar should understand what those loans were all about. And of course, we were setting up the marketplace for ultimate failure because those risky loans, the no down payments, all those sorts of things, those were the first ones that went bad. And this became a tsunami that drastically infected the overall real estate market because all of a sudden you had 33% of all loans in some form of delinquency, which was just crazy. So this was a tsunami wave, if you will, that first hit and completely changed the real estate market. All of a sudden, we saw a lot of foreclosures start, but then stop because of laws and rules and regulations. And the banks started adapting to the new rules and regulations to start to sell notes. And absolutely the best deals in the marketplace were on the note side of the business back then, not the foreclosures. There was a brief window foreclosures were, there was a briefer window where short sales were, but notes really became the pinnacle of the marketplace, where the opportunity was. And you combine real estate with the notes. By the way, that tsunami wave is still something that we're working on today. We still have millions of loans in this category that were originated in that time frame that still haven't worked through the system completely yet. So that was how big that inventory overall was. So we're still looking at that. The second wave was a little bit smaller. Okay, the second wave was really hurricane related. It didn't just affect Texas and Florida where the hurricanes went through, but also neighboring states. And of course, when you have a major disaster like some of those areas had, it causes people financial hardship. Some people never really recover from that, and you had a bump in the inventory. And then the inventory at that time was starting to dry up a little bit, so we had a little bounce of it. Why? Because the industry was going through some corrections. And instead of having a massive, massive amount of loans, it started to shrink. Well, it started to shrink because investors were buying these loans up, big ones and small ones. And as the economy started to change, people were starting to do more workouts rather than foreclosures. So all of a sudden, it seemed like the note inventory opportunities was drying up. And I've been, on the panels and platforms and telling people it's coming back. There is this third wave that is happening right now. You just haven't seen it yet. So yes, we went through a little bit of a dry spell where inventory shrunk. When that happens, your investments become more expensive, right? Your margins start to go down, and there were some people that kind of backed away. Overall, that's going to be a good thing because the opportunity since then is really combining the best of real estate techniques with the best of note techniques. And you're going to see, for those of you who join us at the NoteWorthy Summit coming up, you're going to see a lot of that now because that's where the market is. It's the best of both worlds of notes as they relate to real estate. After all, notes is just the financial side of the real estate. But this third wave, we have already entered into. The third wave here are government insured loans and privately held loans. The lending industry has changed, and for the most part, fundamentally has changed, and it will not go back. So some of the techniques that some of you may be using right now and finding them difficult are only going to continue to get more difficult. You're going to be taking on more and more risk with less and less profit margin, and that's not a smart way to do these investments, and I know that you all understand that. So let me break down this third wave of where the opportunity is and why it makes sense to learn about both real estate and real estate notes in today's world. The third wave saw this. Now, this was a sample study. Let me qualify it that way. The sample study was done. This is not a study in its totality, but all the reports take a little statistical sample to come up with these numbers. And in this statistical sample, they saw a 1% increase overall on government institutional backed loans. So that's your Fannie Mae, Freddie Mac, and Ginnie Mae. And 1% may not sound like a lot to you, but you have to think nationally, right? So 1% increase overall just in the last year is significant. It's enough to go, there's something going on here, because the trajectory was going down where we had less and less of those, and now it just popped up 1%. Again, looks small. Overall, it's something that has been noted in all government reports. Peeling back that onion a little bit further, you see here that VA-backed loans had a 31% increase in defaults. Now that becomes much, much, much more significant. What is going on those VA-backed loans? Are they getting into the bad lending practices again? Look at FHA-backed loans for non-banks, a 17% increase. And again, 17 may not look big to you, but when you think about how many loans are backed by FHA, that is very, very significant. In fact, if you go back, which I have done, and it's not a fun read, by the way, but if you go back and read into detail these government reports starting last year, they already said high debt to income ratios, declining average credit scores, and loans with down payment assistance are of concern. And this is noted throughout all the various government studies that look at these loans on a regular basis. So 1% may not look big on the headlines, but again, when you start to peel back that onion and start to look at very specific things, it becomes significant. We're starting to go down the same path that led us to the big wave that happened back in the mid 2000s. And that's not a good thing for the overall economy. It's of significance for investors of us, because we're the ones ultimately that have to clean up these problems, and problems do create opportunities for those who understand them and for those who have techniques and a knowledge base to overcome those. In other words, an action plan on dealing with those. And that's certainly going to be something of a lot of focus at the NoteWorthy Summit that's coming up. So private loan portfolios, what are those all about? National lenders increased by 3%. What I'm talking about here again is default rate. So in private loan portfolios, let me explain just a little bit. Private loan portfolios are not going through your government institutions, Fannie Mae, Freddie Mac, et cetera. They get warehouse lines of credit and they do their own lending. These type of lenders that do private loans, I should say, pardon me, the private lenders here, yes, they have shareholders, they don't have depositors, and that's a big difference in regulation and what they can do. I've done a lot of study in this particular area, and it's at the one hand fascinating. On the other side, it's also pretty frightening here. So national lenders, their default rate has increased by 3%. Very, very significant, because believe it or not, there's more private loans done in the United States in real estate than there are bank loans. And that's been the case for over 3 years now. And the margin keeps getting bigger. You've got more and more private lenders. By far, Rocket Mortgage is the biggest one in the country by far. And then you have the more traditional banks on a downward trajectory. They don't want to do these types of loans. What's scary is, though, in a big part of this third wave, is that those government entities, the banks, my apologies, the banks are giving the warehouse lines of credit to these private lenders. And the private lenders do not have the same laws, regulations, and restrictions that banks have. So what type of loans are they doing? They are now, believe it or not, we have nothing down loans. We have loans for people with 620 credit scores, 580 credit scores. We have no down payment. We have all sorts of these loans that we did before. Starting to do it again. Banks can't do those loans, but these private lenders can. So private lenders are doing more of these loans. Traditional banks are not, but traditional banks are backing these lenders, and that is also significant to us. So an increased overall for national private lenders at 3%, but look at that other number there. That's not a typo. In fact, I had to reread my research several times on this particular stat because it's stunning. Private loans owned by the mid-market lenders, so not the real big ones like Rocket Mortgage, but the middle market lenders, their default rate has increased 139%. That is a shocking number. And you know what the mid-market lenders look at? Not the big projects. They look at the $200,000 homes and less, $150,000 homes and less. And we're starting to see big jumps of delinquencies in those marketplaces. Again, they're not qualifying people the right way. That's creating problems. Problems become opportunities for those, again, who understand that, who recognize it. And we provide a great service by helping these people out. What we do in real estate, what we do in the real estate note business helps everybody, from the individual to the entire economy. I mean, let's face it, on the big wave of foreclosures back in the 2000s, the government proved to everybody they couldn't handle that. The big banks couldn't handle that. And ultimately, investors like your panel and like some people on the webinar, we were the ones that came in and really created the turnaround in the real estate market here. Now, this is a different source that I've tied into this one. Black Knight Financial Services up in Jacksonville, Florida, they have a mortgage monitor that comes out on a regular basis. This is the one from September 2019, and they're showing the delinquency rate at 6 months after origination of a new loan is trending higher. What does that mean? That means they're writing looser loans, and people are starting to not be able to make payments within the first 6 months. Why is that trending higher? Because we're getting looser, we're using private lenders on this, and the terms are not great. This is all a part of the third wave of inventory that you want to utilize your real estate and real estate note skills to take advantage of the marketplace, understand where these deals are going to be, understand where you need to position yourself within the market. The other trend here is an upward trend in Ginnie Mae-backed loans. Ginnie Mae is 100% owned by the government, unlike Fannie Mae and Freddie Mac. Ginnie Mae is 100% owned by our government. They are backing private lenders to a high degree. So the private lenders get the warehouse loans from the banks, and then they package it and sell it to Ginnie Mae. And Ginnie Mae, the government mortgage association, they are the ones backing all of those. They are starting to see an upward trend. So overall here, what we are seeing is this third wave of inventory that is coming to us. It's going to be in the form of non-performing notes, but also what I don't have in this particular presentation, but I will talk about in my State of the Industry address, reperforming notes. We're seeing more reperforming notes. I've been saying this for a couple of years than we've seen ever, historic highs. And we're also seeing that there are more REO investors like Ben that are not only buying notes, but creating notes, because it's a great way to run a real estate business. Buy real estate as cheaply as you can, utilizing whatever techniques that you do, and then sell it with seller financing. And you'll find that there's a larger and larger amount of those. And Ben, I was hoping you could address that a little bit to what you see in that particular part of the industry.
Yeah, in terms of REOs, we've started to see those dwindle down a little bit, actually. So that creates a question based on what you were just talking about, Kevin, and I think a lot of people are going to want to know, and it was asked in the chat, is do you see a downturn coming where there will be more of these types of notes to buy, or even foreclosures to pick up at auction, through these private lenders?
A crash is hard to say when and if we are in that. I mean, if you look at all the experts, you're going to see some that are saying we're already in it, we just don't know it. You have other ones say it's coming. So again, timing on those things is so difficult to do. Positioning yourself within that is not, though, and understanding that this may happen. We've already started to see some of these loans coming in, because one of the things that did happen out of Dodd-Frank, although it was, there's a lot of things wrong with Dodd-Frank, one of the good things is when banks moved away from foreclosing on everything, they still foreclose, but they do a lot more of selling the paper. And the larger investors start to shuffle that paper out. So we've already seen through various trading platforms, stuff that and such that I'm associated with, we've already seen that inventory starting to hit. There's still billion-dollar sales that they're doing on a regular basis at the larger level. So we'll see it there. But we have seen smaller REO investment companies that their whole business models really are created around buy property in bulk cheap, fix it up, sell it, and sell it with seller financing, get the paper seasoned a little bit, and sell that off. So I think that inventory is going to remain steady. You're saying you're seeing a little bit less of that, though? Is that what you have seen?
Yeah, it's ticked down a little bit over the last couple of months. We in the fourth quarter, we kind of expected to get a lot of deals, thinking maybe banks were going to want to get a lot of assets off the books. We didn't see as much as we thought we would. So going back to that, I think the question I would have if I've never bought a note before, or I'm looking for a note, is how do I get that kind? Where do I find these things? If I'm not able to take down $1 billion portfolio, and I'm just a guy that's got some money sitting in a self-directed IRA, I want to buy a note, I want to maybe get into that space. How can I get involved in buying some of these deals? Like where's the good place to start?
Well, there's a couple of ways, and what I'm promoting and teaching right now, and it may sound a little self-serving on this webinar, but I promise you it's not. I try to position myself where the trends are going.
We won't hold that against you.
I think what investors have to look at, especially on the note side, if you're somebody who's specializing in notes, I think you need to think in terms of, I want my capital to work, whether that's personal capital, borrowed capital, or tax sheltered accounts, IRAs and such. Go to trading platforms. I'm associated with PaperStack. And PaperStack has really digitized the whole process now. There's so many good features that the trading platforms have drastically changed. Really, the tip of the spear is PaperStack. They're right here in Orlando. And they have inventory on a regular basis. And one of the things, just to give you an idea of where the industry is going, when you have these billion-dollar funds up in New York that have $1 billion, or we have one now with $2 billion under management of notes, they don't have a direct pipeline to sell individual notes to consumers. What they typically relied upon was a mid-sized company to buy that and then distribute those or sell those. Well, with that platform, right now as we talk, they are launching a beta program, for lack of a better term, where the big companies can list inventory to an individual where they can buy one note. Now, the only way that is possible is that PaperStack facilitates the whole transaction for closing, because those big companies, they don't have the personnel, they don't have nor do they want to go through a bunch of different closings. If it's handled for them, that could change. So that's going to be interesting to see how that plays out. The other thing I would look at is there's a lot of different note funds today, which on the one hand shows you that the note industry has really become its own asset class. I mean, you have people that just want to diversify their portfolio and invest in notes now. You didn't have that 9 years ago. You probably didn't even have that really 5 years ago. But recently, there's been a lot of companies. Now, you do your research on the companies, right? Some are just accredited investors, but now there's these new A+ funds that allow accredited and non-accredited investors. And again, I do have part ownership in one called the MWM fund, but we fall under that latter category where anybody, accredited or not, can invest in a fund, and then the fund goes and buy notes. So I think you would look at two things: buying an individual note, but also deploying capital into a fund is probably the smartest, safest way moving forward.
So let me thanks for that, Kevin and Ben. Let me add a few comments into that. So really what you're describing there is kind of what I first heard of it probably through Fairway America at an AAPL conference, which is the American Association of Private Lenders. They were launching all their small balance real estate funds and kind of organizing all that and getting that into the marketplace. So let me give a few comments and resources. So I subscribe to a bunch of things. One of them, I'll see if I can put it up there, is the realestatetiming.com right there. So realestatetiming.com. It's written monthly by Robert Campbell. He's local to Southern California and a San Diegan native, but he puts out a report on national trends and then specifically in California. California tends to lead the way, right? It being one of the 10, major metro areas: San Fran, LA, San Diego, Vegas, Denver, Houston, Chicago, Washington, Boston, Miami. Those are the others. But what it was reporting is that from Core Logic is that year over year price gains have decreased in 38 states as compared with the year earlier. And the cooling was greatest in Nevada. Well, those have kind of been all those bubble markets, right? When you're dealing with Phoenix, Vegas, California, Northern California, San Francisco has been in a downtrend since, Q4 of last year. But there's several markets that are showing a pretty big upswing. Like Phoenix is up 6% since last summer. Denver's up, DC's up, Tampa's way up. Chicago's even still up. But so this is a good resource. It's like $100 a year or something. I would recommend going through that.
Aaron, did I put that up there right? Instead of you holding it up, I just typed it in.
Yeah, you did. That is correct. Yeah. I'm refinancing a small portfolio right now, and I went through Finance of America, their commercial division, and oh my gosh, like it's stated almost no doc. They want my FICO, they want my experience and track record, the list of assets that I've, have in possession or done. And then, hey, what's in your retirement accounts? What kind of cash do you have in the bank? It was great. I'm like going through, I'm like, wow, this is pretty awesome. But at the same time, like, okay, well, to your point that you were making, Kevin, here we go again, for these stated low or no doc. You've heard probably some people talking about the VA foreclosures. Well, I just pulled that list up. Kevin, just type in VRM as in Mary, CO, vrmco.com. So that is the portal where you can register, pull up the listing agent, and find the VA foreclosure homes. And that is open to us regular investors as well. There's certain criteria on there, but you don't have to be military, associated with the military, to go and buy these properties with these. This is a rate play, right? All these deals are written at sub 4 on the rate. You may be paying full market price, but you're buying rate. Well, there's 1,128 properties listed kind of nationwide, and you can go drill down and search by your market if you want. So there's another resource and a strategy people are deploying as far as like finding assets. I have a very good strategic partner that's coming out to the summit. They deployed just under 50 million in their own cash. They come from the assisted living space, is where their funds were, but they partnered with my colleague, and he deployed that capital into first position NPLs. They did the workout and asset management in-house, and they're now coming to the summit and other areas to start selling one-off performing loans at like, a 15 to 18 yield for a first position that's been seasoned anywhere from 12 to 24 months.
Can't beat that.
So yeah, exactly. Like, so, and they have hundreds of them that they've cured, and they're still working through their portfolio, and that's their strategy. I was like, well, okay, so are you going to sell some of the NPLs? He's like, yeah, we probably will, but our main focus has been let us, fix the assets, cure, cure the reports, the assignments, the allonges, the chain of title. We'll fix all that. We'll do the modifications. We'll use our paperwork to do it, make sure, and then we'll provide, these good turnkey, for lack of a better word, performing loans now in the marketplace at a more than reasonable yield. And again, they're not properties that they bought for 10K. They are sub 100K properties, but they're more or less, I would refer to as like a class C, single family residence. So that's what I'm seeing. These are some of the resources that I'm going through. And
Yeah, it's
so,
been great, Aaron, to see notes that people bought 4 or 5 years ago and, got them reworked, and they did it the right way. And now those notes, as you were saying, they're beautifully seasoned, track records are great, and they're moving inventory as well, and people are always in a mode of reshuffling inventory. So it's a great time to look at performing notes as well. Totally agree.
what other, let's see, what other questions do we have here? Did I miss any, Ben?
Yeah, we got a couple.
Okay.
So,
Why don't you cue those up?
yeah. So Bill says foreclosures are at a 19-year low. Are you seeing defaults increasing?
Yeah, foreclosures overall are down. That's going through the entire foreclosure process. Delinquencies don't fall into that foreclosure category. So and again, you have to kind of look at the details of how they're looking at the stats. But normally in everything that I look at, a foreclosure, I mean, it's been foreclosed at the courthouse. Before that, it's in that mode of default, and then you have serious or delinquency, and then you have serious delinquency after 9 days. So when I was hitting you with some stats here about, for example, this one, these homes don't fall into the foreclosure category. They're just late. But when you see a delinquency rate all of a sudden is increasing after as little as 6 months of the loan being originated, that means they're not doing good lending practices. That's the only logical conclusion you can come to on that one. So it is tougher if you look at the numbers nationwide, especially, which Aaron just mentioned a good source for that. CoreLogic follows those. They have some good reports that come out on those. It's tougher to buy at a foreclosure sale today in most parts of the country than ever before. You're paying too much for them. There's too much competition, and there's too little inventory. That's just tightening that market up. There's much looser markets, meaning more inventory when you look at alternative sources such as non-performing loans or other delinquent.
Yeah.
Mm-hmm.
Right on. Yeah, I think one thing that I take away from this, and I'm just reflecting on myself, 3-4 years ago when I didn't know anything about notes, which is why I asked you, Kevin, like, all right, let's assume like 90% of the people on this don't have a note. Where do they go? Where do they start? And NoteWorthy is where I started. Like it really was like just where I kind of learned the business from the inside out. And you basically laid out two paths there. There's, you can go to a note trading platform, decide to pull the trigger on a note, or you can invest in a note fund. Mm-hmm. Both great options. It just depends on how involved you want to be, right?
Yeah, yeah, absolutely. Sorry, go ahead.
Yeah, but I was going to say at the end of the day, ultimately you want to put yourself in a position where you're educated to make the right choice, whether it's the right fund or whether it's the right note off of that platform. And I can tell you firsthand, like the things that I learned from the people that come out to NoteWorthy, not only the speakers, but the people that I get to meet that have been doing notes for, 20, 30, 40 years. And before I even knew what a note was, is invaluable because they share their trade secrets, so to speak. But hey, these, when you're looking to work out a deal, this is what the best practice is. Don't do this, but do that. And those things are super valuable. So, if you guys are wanting to add notes as part of your investment portfolio, I'd encourage you to come out to the summit, because the quality and the caliber of note investors that are there, there's no comparison.
There isn't. And let me just add this, and I don't want to interrupt you, but I think it's an important point here. I had 3 closings this week. All of them, even though I know all these other platforms and everything else, all of them were private inventory from private investors that I have met at guess where?
Yeah.
I mean, that's it. So we always say note business, investment business, it's still a people business. And you've got to surround yourself with the right people because there's inventory that simply is not out there. And that's, how do you teach somebody to find the inventory that's not out there? Well, the only way to do it is to get around, network with, become associated with people who are in the industry. If you're trying to do that one person at a time, how many years do you have, before you could build something up? You go to NoteWorthy and boom, everybody is there in the audience, in the booths, and everything else. And it's a quick way to really establish these are the makers of the industry. Let's work with them, associate with them. I agree 100%. That part of the industry will never go away. As much as technology is good, that part of the industry, if you're ignoring that, you're making a mistake.
I'm glad you brought that up, because part of the reason I moved, I mean, all my family's in Phoenix. You know, we have zero family in Southern California. Now, we're not far from family, but, you know, for those of you who know me, I have 6 children. So, so being surrounded by a community and family is important for some help and support. Part of the reason we moved was so I could be close to the action in the note space and the family offices and the hedge funds that were up in Orange County. And so that was a big part of our decision. I was like, you know, honey, I got to be close to the action of what's going on. And it's not in Phoenix right now. And so, you know, now we split our time between both places, but, you know, that was a big deal. And you can't substitute the power. I love technology, as long as like we work with it and it doesn't work against us, but nothing beats the power of just connecting with live, real people and making that human connection, you know? And so some of my closest and best friends and business partners have come through, you know, live events, workshops, things of that nature, you know, more so than doing a webinar or a phone call or anything like that. So that's like, will continue to be my motivation, and why even continue to put on live events. I mean, these, for those of you who've been, they're not like big money makers. You know, if anything, they cost me money and I go negative on them. But what comes out of it turns a positive, and the relationships, the contacts, the inventory made, the vendors that are, you know, there to connect with. And so it becomes your extension of your business and your power team. And that's why I love it, support it. I know Kevin's a big proponent. I thank you, Kevin, for being a road warrior for I don't know how many years and doing all those trainings and workshops like that. You know, I'm forever grateful for that, because I went to those, and that's why I learned so much stuff. So, you know, these market updates are important. It's good to come out. I hope y'all can come out and join us the end of February. It's going to be great. It's actually right across from Disneyland. You know, Ben and I wanted to take our kind of mix a little business with pleasure. So we're going to do a little Disneyland adventure after the summit's over. So, but yes, okay, there we go. We have wow, I didn't even know, I missed a call earlier. So we're doing tickets for $97. Great. So special 97, all lowercase in the promo code. And you just go to that link right there, noteworthysummit.com/tickets. And we're going to do 50 of them, it looks like. Okay, great. So space is limited. We didn't book a huge venue. In years past, I kind of have booked bigger venues and was on the hook for big room blocks. I think we already sold out of our hotel room block. But the venue can only hold about 2.25. So we're getting pretty close to that. So I hope y'all can make it out. So that's a great offer, just $97 of tickets. We have, you know, a couple networking receptions, lots of snacks and, you know, hors d'oeuvres and a welcome reception. We'll have a real good time together, have some great vendors coming out. We've added more panels this year. In years past, I've only done a couple panels, and Kevin been like, man, we really needed to start doing some more panels. So we're going to do that. So I'm excited for those that are moderating and the people that are participating in that, coming out on their own dime to share with what they're doing in the space. So again, we don't have much of stuff we're pitching. You know, we do believe in continuing education, make an investment in yourself. If, you know, Kevin has courses and stuff he does, if you're welcome to participate in that, but no one's pitching it from stage. So you don't have to worry about that. If vendors have resources, go visit them at their booth, and we just try and keep it real simple and rock and roll. So.
Hey, Aaron, let's cover some of the things that we're actually going to be talking about there. So,
great. Go ahead.
You know, one is going to be, you know, sourcing more notes, ways that you can find deals. We're going to be talking about brokering notes. We're going to be talking about raising private money. So we're going to have an SEC attorney there, you know, talking about being compliant when you raise money. We're going to have a multifamily syndicator there talking about how they raise money. So it's not just notes. It's going to be expansive. So if you are, you know, are in a position to do self-directed IRAs, or you want to learn about that, you want to learn about partials in notes, non-performing, performing. I mean, there's going to be just a plethora of information there for you guys to learn about. And I'll tell you this straight out. This is the only reason I got involved with Noteworthy, is because going to these events has literally made me hundreds of thousands of dollars, period. While I started out as a vendor, all the other vendors would be sitting at their table, like texting and checking Facebook and stuff. And I would go sit in the room and listen to guys like Eddie Speed and, you know, Kevin and other people in the industry, and just soak everything in. And I would scribble notes down furiously. And I would go home and say, there's no reason I can't do that. And then literally year before last, Noteworthy, Aaron was gracious enough. He named me Note Investor of the Year. We did something like 150 notes in 1 year, you know, and I was a guy at the time when I first went to Noteworthy, I owned 6 rental properties. That was it. Like, I was no big shot by any means. I'm still not, but it was like trying to just learn and apply as much as possible. And that's the biggest reason I got involved in Noteworthy. So I'm telling you, for $97, if you can't 100x your money from that, like, you're just not even trying, from the information that's going to come from this event. So we hope to see you guys there, because it's invaluable.
Absolutely. I don't have anything else. Kevin, you have some closing remarks. Go get this book, Timing the Real Estate Market, 5th edition. Robert M. Campbell, same guy that does the realestatetiming.com. It's like $35, but it's a good read. You'll enjoy it. It's not just California, it's nationwide, but go pick up. I know we got a lot of people that are really focused on the market conditions, which is great. It's totally cool, because we got to move with the market. So I study that too. So that's why I'm sharing that resource. Kevin, what else do you have?
No, I'm looking forward to being there, and I will be there in person and doing a couple presentations. I promise I won't talk as quickly as I did tonight. I just had a lot of information in a short period of time, but I look forward to meeting everybody face to face.
All right. Do we have any more questions before we wrap it up? Oh, great. Here we got one. Aaron, who cut your hair? All right. Well, I do that myself.
Yeah, that same person started on mine. I stopped. I didn't stop him quick enough, I guess.
Oh, that's good. Well, thanks everyone for being on. Ben, do you have any other closing comments?
I'm good. Just come out to the summit. We look forward to seeing you there, and we appreciate you guys tuning in tonight. Go
Wonderful.
enjoy your.
Thanks, everyone.